Hello, everyone. It's Tamika, your realtor. I'm going to push play, record just in case we want to do this later or someone wants to come back and look at it later. As I promised, I'm going to be doing this weekly, just questions and answers about real estate, especially since we're going through so much and things are changing week to week, sometimes day to day. I just want to keep you guys in the loop, whether you're buying, selling, or refinancing. So this is your chance. Today we have Marcus Nole. He is a lender. Hi, Marcus. Marcus, tell us a little bit about yourself. And excuse my office. I wasn't supposed to be in here.
No, it looks fine. Looks like you're working. So I've been doing mortgages for 20 years now. Actually 21 coming up. And I'm native to Baltimore. I started with NFM lending originally, and I worked for Wells Fargo for several years. I opened my own branch for NFM, and now I'm back here again. So I have a lot of experience in both refinances and purchases. My focus right now is purchases, even though everybody's refinancing. My passion is in getting people homes.
Awesome. And Marcus has worked with some of my clients to get them qualified and into their first home sometimes and second homes others. So this is awesome. So with today's focus, and unless someone has any questions along the way, if you have any questions, feel free to type them in and I will grab them and we will answer them for you. And even if this is after we get off air, I'll still make sure you get the answers that you're seeking. So I'm just going to ask a few general questions just to get our conversation started. So when a new buyer comes to me, Marcus, the first thing I ask them is, have they spoken with the lender to find out what their purchasing power is? Mm-hmm. And can you tell me a little bit about what they should be prepared to do or what they need to be prepared to ask you when they reach out to you when they're thinking about buying a home? Like, what are some of the things they need to be aware of?
Right. Well, first, it's great that you send them straight to be approved because that's the most important. It's like shopping without money. It's going to be pretty hard to do. The first thing that I speak with them about are the three main things that it takes to purchase a home, which are credit, gainful employment, and many times money. So I tell them those are the three things. I make them aware of the minimum credit score and the different programs that are available. And then we talk about down payment, closing costs, the difference between them, and how much they can expect to need. So we talk about that is our initial conversation. And then I try and get documentation from them once I verify that they are capable of buying.
Perfect. And I'm glad you said that because when I send them to you, one of the main things I say is I need you to know how much money you're going to need to bring to the table. Like that's a very important component to how I can help them. I can't even help them if they don't know that, right? That's great. And so right now, I know, like we mentioned earlier, we're in a different kind of situation in terms of financing and requirements, but can you let us know kind of some baseline things that they need to think about in terms of their credit scores? And I have a follow-up question to that too.
So there are different types of loans. There's FHA, there's conventional, there's VA, there's USDA. Different requirements for different loans. FHA had a little more lenient, of course, on credit scores and debt to income. Conventional, a little stricter, but you may have less of a mortgage insurance premium if you're not putting down 20%. So from the basic amount of a credit score that you would need, you're talking normally a 620 is where we start at. I can do a manual underwrite at a 580, which is rare that things line up that way, but 620 is my normal minimum score. And of course, 2 years of full-time employment is important. You don't have to be employed by the same employer. A lot of times people think that's what I mean. You could work 4 different jobs as long as they were continuous and you've done it for 2 years.
Okay, so as long as they were consistent and continuous. So a question that I get a lot from my clients is, what do I need to do if I need to increase my credit score? I don't have any lines of credit, or maybe I have one. I've paid off all my credit cards. I don't have any bills. And it feels almost like not having bills sometimes works against you. So can you tell me a little bit about the importance of credit lines?
Absolutely. So revolving debt is the most important kind of credit you can have. Installment loans don't give you as a big of a boost to your credit score as a revolving debt. And by revolving, I mean a credit card, meaning somebody that's not attached to an item. There's nothing to put a lien on, like a car or a piece of jewelry or something like that. You want to have credit card debt. I know it sounds strange, but that's going to give you the biggest boost to your score. And you want to have available credit. So having credit cards and not having any credit available is an issue for people, and it keeps their score either the same or going in the opposite direction. So if you have two small credit cards, let's say a $500 card and a $1,000 card, you want to keep those cards under 30% for the maximum score boost each month. And each month it will go up as long as you're paying everybody on time. The number one thing to do with your credit, of course, is pay people on time, but then you want to have proof that you are willing to pay somebody without the threat of them taking something from you. That's why revolving works more in your favor than an installment loan, because if you don't pay the car note, they're coming to get the car. If you don't pay the credit card, you're just going to have bad credit. So it counts more that you're paying somebody on a credit card.
And you said it needs to be less than 30% use?
Correct. And we're talking usage. So in the example of $1,000 card, you want to keep that balance under 300 to get the biggest bang for your buck. You don't need to pay it off completely, but if you've got a $500 card, then you want to get that thing under $150 to have your score go up, and of course, pay it on time.
Great. Okay, awesome. So I got a question here. With the VA loan, is it still wise to put a down payment towards your home purchase?
I don't think so. The VA is a great loan. It gives you 100% financing. Unless you're selling a home and you want your mortgage payment to be lower, there's no real reason for you to add money into that loan, in my opinion. And from a financial perspective, take the example of you're buying a $200,000 home and the VA is going to loan you $200,000. To put $20,000 into that to make it a $180,000 loan doesn't give you a big enough bang in your payment to make sense of you putting $20,000 there versus somewhere else like a mutual fund or a stock market. It just makes more sense to have your money on hand for that rainy day than to put it into a mortgage you don't have to put it into.
Great. And the VA is probably one of my favorite loans. I love working with veterans. They're so easy to work with, number one, but it is a great loan product that a lot of people can't take advantage of. So I'm so happy that they're able to do that. So that lends me to another point. With the down payments, can you tell me what the differences in down payments are between the VA, FHA, and a conventional loan?
Okay, so VA, you had the option of zero down, which means you're financing 100%. Conventional, the normal minimum is 5% down as a down payment, and that's score related and income related. And with FHA, it's 3.5%. Now, I do have a conventional product that allows you to only put down 3%, which I use a lot. So I'll say the normal minimum is 5% for conventional. The normal minimum for FHA is 3.5%. And some people ask, well, why would I do FHA if I could do conventional? Well, because FHA has some benefits that conventional doesn't, meaning you can go a higher debt to income, and we'll get into what debt to income means, but you can go, of course, a higher debt to income, and you're allowed to get more in closing costs out, from FHA. So
wow, I didn't know that.
Yeah, FHA, you're allowed to get up to 6% from the seller. Now, it's going to be rare that you can get that, but there are situations where a house has been on the market, and the only way the deal is going to work is if the seller is willing to contribute 4 or 5 or even more. FHA allows you to do that, where conventional caps you at 3%. So it's common that a $300,000, $400,000 house has 4.5% worth of closing costs, and they can only give you 3 in a conventional situation.
Well, that's really, really good to know. I did not know that. So that's awesome. And so I thought that the biggest thing was the difference between PMI and not paying PMI. Well, is that one or the other?
You're going to pay PMI regardless if you're not putting down 20%. Now, there are options in conventional that you don't have in FHA. I don't want to make you think there's no upside to conventional. In a conventional loan, if you only put down 5, 10, or even 15%, you will have PMI. The difference in the conventional loan is the PMI will come off when you get to a 20% equity mark, where FHA, it's on there for the life of the loan unless you refinance it. So
Gotcha.
the conventional PMI is sometimes a little less. You know, when you're putting down 5% or 10% than an FHA loan, which is going to be a set amount of PMI. But also when you're talking conventional loans, there's an option to buy out the PMI in one lump sum. It's called lender paid mortgage insurance. So if you have a decent credit score and you're putting down 5%, you can pay up front one time a fee and not have mortgage insurance, even though you're not putting down 20%. So that's an option that I use for a lot of our clients as long as it works.
Yeah, if they have the cash to do it, I'm assuming that needs to be done up front, right?
Well, it's done within the loan.
Gotcha.
And to give you an idea of how much it costs, it's usually anywhere from 2 to 2.5% of the loan amount. So if you're talking about a $400,000 loan, you're talking about $8,000 more that you'd be paying, you know, in closing costs than you would normally. But if you have a great realtor like Tamika and you've negotiated, you know, a decent amount from the seller, that can go towards it. So anything you get can help you with your costs.
That's great. And so you mentioned debt to income ratio. Yes. So I know that's another consideration when you're considering how much a person can buy or what their purchasing power is. What is a suggestion in terms of where that needs to be to get the best deal or the best mortgage?
So most conventional loans, as long as you stay under 43% debt to income, you're going to qualify there. FHA, I can go as high as 55% debt to income. So a significant difference. And sometimes the debt to income doesn't show the true picture. For example, you may have a couple and one has a credit issue, the other doesn't. One can afford to buy the house by themselves, but they'd be stretching themselves because the debt to income is obviously over 50%. Well, the fact that they're married and their spouse is going to be helping them, but it's not on the loan. We know that. I know that when I'm writing the loan, so I feel comfortable writing a loan at a higher debt to income. The debt to income number that you want to be at, ideally, for a conventional loan is under 43%. For an FHA loan, I would say under 50%. Those are your numbers to qualify. But if we have to push it on conventional, we can push it up to, you know, close to 45, depending on compensating factors. And compensating factors are usually money. So,
yeah. So when we talk in debt to income, so 55 or 50% of your total income, or what is the total that we're looking at?
So the way we calculate that debt to income number is, imagine someone makes $5,000 a month, right? Or let's say
before taxes or after.
This is gross, right?
Okay.
So $60,000 a year. Okay. They make $5,000 a month. Their $2,500, which is half of that, would be 50% debt to income. So the way we calculate that is, that's the maximum amount of house payment that you can get, right? If you had no debt. So someone who makes $5,000 a month can get up to a $2,500 house, right? And that's everything, taxes and insurance included. But what we have to do to figure out the debt to income is we have to subtract everything that's on the credit report that has a payment, including student loans, right? So if you have a car note that's $500, your buying power just went down to $2,000. If you have a credit card bill that's $200, it just went down to $1,800, so forth and so on. And that's how we get to the number. So it's very realistic for somebody who makes less to be able to afford more house than someone else just because they have a lower debt load. So what we're looking at, what our underwriters are looking at, is your ability to repay the loan long term. So doesn't matter that you make $200,000, you have a bunch of debt. You've got 6 cars, another house, a whole bunch of student loans, and a bunch of credit card debt. Well, you don't make any more than this person that makes $100,000 to us, because we're looking at what you have to spend.
Wow. I think that that's a powerful statement, because people think just because they make a certain amount of money, they should be able to have certain things. But what they don't take into consideration, the debt load, is what's stopping them from having it. And you also segue into another good point, because I work with a lot of, I call them move up buyers. Like, they need to buy and sell at the same time, or they're trying to decide if they want to keep the starter home that they bought when they were single and now they're married, buying a home together. So that mortgage payment, this is the question I'm going to get. If they have a tenant in the property, and can they count the payment from the tenant as income so that they can then continue to purchase another home and keep that one?
Okay, so the answer is, Yes and no. So they can use it as income um, as long as they have a history of being a landlord. Meaning,
Mm.
if you've been a landlord, everything's done in 2-year increments. We want to know where you've been working for 2 years, where you've been living for 2 years, what you've been doing as self-employment for 2 years, which this is going to count as self-employment or a business because you're renting the house out. So if you rented the house out 6 months ago, um, then it's different than if you've had it for 2 years and you've claimed it on your taxes, and this is part of your income flow to your home that we can show that it's income. So the easiest way to explain it is if you're departing a house, say you have a house and you don't want to sell it, right? Or you can't sell it, it's upside down. You can give me a lease agreement as long as you qualify for a conventional loan. You can give me a lease agreement and we can rent that house out and offset that mortgage. We can't use that lease agreement as income though. So you can't say I'm getting $2,500 worth of rent from this and I only owe $1,000 a month and that's $1,500 more I want to count towards my income or my debt to income. But you can offset it so that we can have a clean slate so it doesn't look like you're affording two homes.
Got you. Okay.
And
Yeah, because that's a question I get a lot.
Yeah, if you're in the business of renting homes, then we're expecting you to put it on your taxes, which people don't always do. So it hurts them. Or they take a loss. That's the whole reason they have the business. So if you take a loss, my goal, I don't want to look at your tax returns if I don't have to.
Right.
So not truly self-employed. I just want to see your W-2s if you have those. But if you're going to claim income from the homes, then we need to see that you actually did that with Uncle Sam.
Okay. Okay. Yeah, I always have people who try to get around that one a little bit. Like, Tamika, it's rented out. Okay, but make sure that you can afford. And I would say you need to make sure you can afford both mortgages. Well, at least the bank needs to make sure that you can afford both mortgages in the event that your tenant is not in the property. So it's still your house.
Correct. And the rules change, Tamika. The rules change if you're going a certain amount of distance. So if you're going 100 miles away, I may be able to call that a second home, depending on where it is. And, so you can have more than you can have more than one home, of course, but there's rules before the underwriter is going to believe that that's what it is. So,
okay. So now I have to ask the question because you from Baltimore and we're so close. Somebody buys an investment property in Baltimore and they live in Prince George's County, for instance. That's a second home.
Maybe. It depends. It depends if it's on the water, if it presents a reason that you would have two homes so close and be a second home. Maybe you work here and you live there. But usually what we're looking for is a distance. 100 miles. It's in Ocean City. This one is here. It's in the mountains. This one's down here in the city. So they're looking for it to make sense. The beautiful part about NFM is I do have in-house underwriting.
Right.
So I'm usually able to run scenarios by our head underwriter prior to putting somebody out on the street and looking for something. I try and take care of all issues up front so that my clients don't have any hiccups in the process of actually buying it. So if the situation is unique, I just ask it to be presented to me and then I can run it, up the flagpole and figure out what we need to do and how we need to frame it.
I always say that's the beauty of working with a mortgage broker versus going to a bank.
Right.
I feel like that
hold on. Let me correct you. We're not a broker.
Not a broker. Okay.
Mortgage lender.
Mortgage lender versus going to a bank.
Exactly.
Because I feel like a bank has very boxed in products that they can offer you, whereas a lender can be not creative for a bad sense, but just everybody's situation is different. It just is.
It's our money. It's our money. Yeah. So we can decide that we'll take on the risk.
Okay.
And that's the difference. There's nobody to talk to at the bank. I worked at Wells Fargo. It either fits in that box, like you said, or it doesn't. And they're fine with it because that's not how they make their money.
Right. Okay. So another question. If you have at least $10,000 in a 401k, can you take that money and use it towards a home purchase? I'm not sure we can answer this question without any penalties. I think that's probably going to be specific to the 401k, but you tell me.
Well, here's the thing. Yes, most times I haven't seen a 401k in my career that won't allow you to take the money out to buy a home. There are some 403Bs and some TSP savings things that have certain regulations, but unless you already have a loan out, usually they'll allow you to take that money out to purchase a home. And I suggest that, especially if you're not anywhere near retirement age, that's the best way to do it. I would much rather spend the money out of my 401k and pay myself back, or not pay myself back, than to take my cash or my actual personal savings, because the 401k is going to get built back up. So normally you can get at the $10,000 without a penalty, but they will actually pay taxes on it. So you're not going to get the entire 10. They may take the 18% up front, and you may have to deal with the state yourself.
Okay, and that was a really good question. So places where people are able to get additional monies, I guess was where that was coming from. So if you have a TSP or you have a 401k and you need additional down payment money, that's some place that you can definitely look.
Yeah.
Great. So another question, is there a limit on how many investment properties a person can own, or it just not matter based on their income?
Good question. So yes, there's a limit on how many you can finance. How many you can own? No, you can buy as many houses as you can afford, but most banks are going to stop financing you at 10. And that's just, when I say financing, I mean traditional investment property financing. Usually when you get to that point, you're no longer going to want to do the kind of loan that a traditional bank would do anyway. But 10 is the number where you're normally you're gonna have trouble getting financing. Now that's finance properties. That's not property.
That's someplace that. Okay.
You could own 10 and only have 5 financed. So.
Well, I mean, that's the goal, right? Don't you want to own all your properties outright? I mean, I do, for retirement sake, and then I can sell them all when I'm ready to be over it. All right, let me see if there are any other questions, or any that I can think of that people ask me all the time. So we talked about the credit score, we talked about the debt to income, we talked about investment properties. Is there anything else that you hear all the time, Marcus, that you feel like you should?
Let's talk about the money, because that's the money is what I hear about all the time. You know, when they talk to me, they want to know about a lot of times about if they had bankruptcies, if there was divorces. Student loan is always a big question, but having the money right, of course, is crucial. So we talked about down payment. What that is, 3.5%, 5%, no percent on VA. USDA also has 100%.
Yeah.
So if you find something that's rural, you look on the USDA map, there are a lot of properties that you wouldn't think are considered rural that are rural. So check that out for people who are interested in, don't mind, a country road. When we talk about closing costs and down payment, both of those things are different, but they're both the responsibility of the buyer. And it's a hot market right now. I know, especially in PG County, Upper Marlboro, Howard County, Anne Arundel County, a lot of these places are hotbeds for purchases. And you have to have these days your down payment and much of your closing costs, no matter how good your realtor is. When the seller has multiple offers, you're going to have to be very competitive. And what that means is you're not only going to need that 5%, but you may need that additional 4% to take care of closing costs, depending on the size of the house. So I'll just give you an example. A $300,000 house is going to have probably about 4 to 4.5% with the closing costs. Let's call it 4% closing costs. Okay. That's $12,000 in closing costs. Then if you're doing an FHA loan, you're talking 3.5% down payment. That's $10,000. So you've got $22,000 that the buyer could potentially be responsible for. If the seller gives you, let's say, 2% of that, that's 6,000 from that 24. Now you only need 18. But if you don't have the money, then we can't get you the house, and I can't send you out there. So what I do in my practice is I'm going to verify what you have, and then I can relay that information to Tamika. Look, they're going to have to get 2% closing costs out, or they can't buy the house. And that's just the situation sometimes, and we have to look for that situation to exist.
And I'm glad you said that, because my very first buyer consultation is know your numbers. And that's the reason why it puts you in a more powerful negotiating position when you know how much money you definitely need versus what you can be playful with. Right. Ideally, we want a buyer to have all of their closing costs themselves. That's what I would like.
Yes.
And we always ask, but we ideally want them to have it all, because you're right, we're in a crazy multiple offer situation right now. Every single offer we make, you're competing. And at the end of the day, the seller wants to make the most money. That's their angle. You want to pay the least money. You see how that works? So if you have some and then they say, okay, well, I don't want to give you 3, but I'll give you 1.5, at least you know what that number is. And although you might not want to put it up front, that's what you might have to do to win your dream house. And it's just better to be in that position than to be trying to figure out where the money's coming from while we're at the table trying to write an offer.
And that's why I say the 401k is always a good option as a backup. So I always ask for all assets. Like, okay, tell me, show me what you have in the bank and give me your 401k statement, because if push comes to shove and you're going to need to spend this money in order to get the house, I want to know that you're okay to do it. You know, everybody wants to get in a house as cheap as possible, and that's always our goal. But you know, when you run up against a nice house, you're not the only person that thinks it's nice. So it's going to be competition most times. And that's also more of a reason that you want to be super ready with your finances, so that when you see the house, you can make the offer, because usually the first offer, and you correct me if I'm wrong, usually the first offer is the offer that they look at the hardest. So
it is.
Yeah. So if you see the house that day, which, you know, Tamika is going to put you in front of many times, this is the house, you want to be ready to write on that and be the first person in there and get the negotiation going.
And I always even tell my sellers, your first offer is almost always your best offer. So you put your best foot forward going in, and the only way you can do that is to get that pre-approval. Like, I don't take anyone to see anything until I know that they're pre-approved. And I get some pushback from people who aren't referred to me. My referral people, like, they're great, because the person who referred them have already prepped them for us. But when I get someone off the street, sometimes they're like, well, why do I need to get pre-approved? And I'm like, listen, I'm not, and especially now in the coronavirus time, you can't just be rolling up in people's houses not qualified. It's unnecessary exposure, number one. Right. And number two is, like, only serious buyers are coming in my house right now. And so a lot of sellers are asking that your clients have a pre-approval letter before they even accept the appointment.
True. I always compare it to going out shopping for something without having the money with you. You know, it's a waste of time, truly. I mean, it's not, everybody likes a good window shop, but this isn't that. You know, when it comes to a house, you don't want a window shop. You don't want to see houses or walk around. If you can't buy it, you may as well not, you know, get in the car and go see it. It is something that is it's an emotional purchase. Of course, it's a huge purchase, and you want to take it really seriously, as we do. You know, we want to make sure that you have the money to do what you want to do. And if you don't have the money, then you know what you need to get, you know. So that's a big part of what I do day to day is if you can imagine, try and qualify everybody, but everybody doesn't, and I have to give them a roadmap to get there. So if you don't have all the money or your credit's not perfect, don't be afraid of that. You know, it's okay. You have to talk to a professional to find out what exactly you need to do so that you don't waste any time or any money putting it in the wrong place. People, if you ask your, you know, somebody that you know, they're going to tell you the wrong thing. So I definitely promote asking a professional. Ask Tamika, what do I need? And we'll get you there.
I love it, because I get a lot of people say, oh, I went online and they said in order to boost my credit, I need to do this and this. And I'm like, stop the brakes. Let you talk to somebody who can tell you exactly what you will need to do in order to get you to where you need to be. And I always, you know, I try not to discourage, because home buying is a process. It's not like most people just can't just roll in and say, I'm going to buy a house today without having to do some type of things to their finances to get ready for it. Yeah. So it's definitely a process. And I always tell people not to get discouraged, because it can happen. I've helped so many people who never thought they could buy a house before actually get a house. If you're paying rent $1,500 or more, you can buy a house. You might have to figure out, you might have to figure out the back end of how to make it happen. But if you're already spending that much money, there is no reason why you should not have a home of your own and take advantage of the tax.
You are buying a house at that price. You're just buying it for somebody else. I mean,
so Toy, tell me a little bit more about your question. You said chat about two people buying together. Are they married? Are they not married? Talk to me. Good credit, bad credit. Give me a scenario. I will give you one scenario on a the VA loan. Okay, she said, what if one person is weaker than the other with the credit and income wise? I think we touched on that a little bit, Marcus, but say, and I have a client like that now, say someone has super great credit, and so one person is the credit and one person is the money, is how we call it. What are the challenges with that, and how can we kind of overcome that, if at all?
Well, unfortunately, when two people are purchasing together, we're looking at the lower of the two. And we're looking at the middle score. So Equifax, TransUnion, Experian, we're going to throw out the high score, throw out the low, and the middle score is going to be your score. So there's no average being done. It's just your middle score. And that's how most places will do it. So if the middle score of the weakest borrower is a 660 and the best borrower is a 720, we'll take both incomes into consideration, but the deal is being rated on the lower of the two, regardless if that person makes the most money or not. So in certain instances, it makes sense to take one person off the loan if the one that makes the most money can afford it and they happen to have the credit. But if the person that doesn't have the income has the best credit, it doesn't really help the person who has the money unless that money is needed to be approved. Now with couples, that can get a little dicey because people are like, I want to be on the loan, I want to be on the loan. It's more important, keep in mind, that you're on the title. The loan is the financial responsibility, and that can get to be contentious too, because people are like, well, I want you to be financially responsible with me. But usually it's more important that both people own the home. Nothing can be done without the other person's consent. And
Right.
if you can't be on the loan, you can't be on the loan. Don't be upset about it.
And I've definitely I've seen that happen. I've actually seen that happen with the VA loan, where the wife they weren't married yet, they were engaged. And the wife was the veteran, and so he couldn't be on the loan. But he couldn't even be on the deed with a VA loan. They have to wait until after they get married to be added. So that's something as well. And I think it's good if one person can buy the property and tie the mortgage up on one person than the other, just to leave the cash free. Yeah, so that they can, purchase other things and maybe buy some investment properties under the other person's name. I think that's a good strategy if you're long-term with this person.
Yeah, it's definitely a good strategy, because leaving one person off sometimes leaves them free, like you said, to do other things. But also life happens. People go through things, and you could run into a situation where you have to file bankruptcy, and everybody doesn't have to file because this person isn't on the loan. So you can get back on your feet using the other person's credit and income sometimes.
That's awesome. And so this is a good question that Sway brought up as well. She said, are you guys using a special credit bureau? Because like I had a client tell me this the other day, they look at Credit Karma and stuff like that, and they say their credit score is one thing, but in reality is something else. Like, what are we believing, and what's the best one to go with besides going to you and having your credit hard pulled?
I deal with this daily. Like, people call me and tell me my credit's a 680. And I always ask them, who pulled it? And they're like, no, I got this app. So Credit Karma is not accurate. It is accurate in that it's telling you what could help you, and it's telling you what just happened if somebody pulled your credit, but it's not accurate from a score standpoint. A lot of what Credit Karma and those kinds of, I think I have one through Capital One, what they pull is just your consumer debt, or your, or not a complete debt profile. So a mortgage credit report, or a report that you pull through the actual bureau, Equifax, Experian, and TransUnion, is your actual score. Sometimes though, Credit Karma is right on. So it's hard for me to say it's never right, but I've had people say I have a 680, I pull it to 680. I've had people say I have a 680, I pull it to 630. So they are hit or miss. And I always tell people it's free. So you're getting what you pay for. Every time I pull somebody's credit, it costs me $35. So when I pull credit, I'm paying for it to get a tri-merge, and it's the actual credit. And even though I'm not supposed to, I don't have a problem sending you a copy of your credit if you're serious about buying a house, because I want you to see what you have to do.
That's awesome. It's a good point. Well, I know I said I wanted to keep this to 30 minutes. So if there are any closing things that you feel like we need to just still up for the buyers out here who might be considering purchasing?
I guess one thing I would say, especially for new buyers, don't be afraid of it. It's not that daunting a process. It's mostly paperwork. You don't have to get your dream house, especially if it's your first house. And it is a financial investment. It is much more of a financial tool than it is just a place to live. I know people, realtors try and get that through to people all the time that, you know, you're paying rent and it's not going anywhere. People are afraid of the upkeep of the house. These are not things that you should fear, because in the end, you're going to make money off of a house. And I used to say 99% of the time, because of course, years ago, we had that blip in the market where property values went backwards. I think that was the first time in 80 years that happened. Yeah. Don't worry about that kind of a thing. If you buy a house, you're going to make money from buying the house. And sometimes you can't see that until you actually do it. But that is a big part of what you need to do to set up your finances. And most of us aren't getting any younger. So owning a house is going to be a cornerstone to building wealth. And if you don't, the sooner you do it, the more you'll build. So that's what I say about it. As far as buying one, do it. Even if it's not the one you want, do it. Do it.
And I'm glad you made that point, because, you know, with everything going on with Black Lives Matter and protests and all of that, and people ask me, well, are you protesting? I was like, you know what, being an activist is not my ministry. I feel like I'm supposed to be educating my people in my community right now on how to build wealth.
Yeah, my
build our community.
Protest. It's a financial protest. I mean, that's what this is. You know, having something to leave in legacy is what I always talk to my kids about. You, at some point, you're doing it for you, but you also are doing it for the people behind you. You're setting an example in your family. I've had so many people come to me like, I'm the first person in my family to buy a house. I'm like, wow. You know, so that it makes me feel, you know, just happy to be connected to that. But I know once one person sees it, then the next person says, well, if they did it, I can do it. You know, I can do it. You know, if cousin Keisha did it, then I can. And that's how we have to think, especially as Black people, that we have to, you know, build wealth so that we can, you know, have something to leave. And that's what it's about.
I love it. I think that's a good note to leave it on. So definitely, I'm going to put Marcus's information in the notes, but go ahead and tell them how to contact you, Marcus.
Yes. So if you need to reach me right now, of course, I'm working from home. So you can call me directly on my cell, 443-676-6328. My email address is M, like my first name, Marcus, Nole, like my last name, Nole, at NFM Lending. That's National Fidelity Mortgage Lending.com. So reach out to me, email or phone. I have an electronic app, online app that I can send you. You can fill out an application. If you need to talk about your specific situation, I'd be happy to do so. Please remind me that you're connected through Tamika, so that I can make sure that we're all working together. But I love working with Tamika. If you're hiring her as your agent, you're doing the right thing. I'm going to tell you this. Look, I work with a lot of agents, and I'm not talking about anybody specifically, but a lot of people don't know what they're doing. And unfortunately, that's just what it is. And you won't know, you know, from looking at social media, who knows what they're doing and who doesn't. But a lot of people are really like learning as they go. And with Tamika, you've got a seasoned veteran who knows what she's doing. She's a hell of a negotiator, and she's going to get you where you need to go. So that's important to me. And those are the type of people that I like to work with. So,
well, thank you, Marcus. It's been great working with you in the past too. 20 years, that's a long time. And I always tell people your realtor and your lender are your team. So you better choose your team wisely if you want to make it to the finish line. So I'm looking forward to bringing more buyers to you and working with you in the future. Getting these folks in these homes, starting these legacies, and just building our communities. That's what it's all about for me right now.
What it's about. Thank you.
Thank you, Marcus. We'll
Let's
talk
do it
soon.
Again. We'll do it again too. We got to do something and just well, maybe I'll set.
I think we should do it periodically. Like I'm going to be doing this question and answer situation every Wednesday at 1. But I guess it'll be various real estate topics. But we should definitely have you like on the schedule, like consistently.
You know, anytime for you, Tamika, just let me know.
All right. Thank you. Have a good day. Thanks, guys, for watching.